Warren Buffett has become one of the world's richest individuals, starting with just $1,000 to invest in the stock market. This video presents his 6 key rules for investment success, helping you find better opportunities and significantly improve your results. Investing in Warren Buffett's company, Berkshire Hathaway, when it traded at $10, would have grown to $100,000. This reflects his success as an investor, and he has shared these 6 rules to benefit others. He began investing with less than $10,000, inflation adjusted, now worth over $100 billion. This video covers these 6 rules, which are easy to apply and can save thousands if you pay attention. Buffett claims anyone following these tips can achieve wealth and financial freedom through stock investments. The first rule is that great opportunities exist for those who seek them patiently. At age 12, Buffett tried to get rich through horse race betting and lost money, but learned a low-risk way to earn. At racetracks, inexperienced bettors discarded tickets, assuming they were worthless if their horse lost. Some tickets won due to secondary bets or combinations. Buffett collected these to find winners, requiring extra effort and knowledge. He realized the stock market worked similarly, leading to significant wealth. He has sought exceptional businesses that perform well. Investing in everything yields average results, but targeting exceptional investments, high growth or undervalued businesses accelerates returns. Buffett invested in companies like American Express, multiplying his money when cheap, and Coca-Cola, bought during a temporary drop after a failed new formula, later multiplying his investment 20 times. Recently, he invested in Domino's Pizza and Google, seen as risky due to artificial intelligence. Yet these businesses continue growing and creating value. A Barron's article supports Buffett's approach, finding that 96% of stocks from 1,925 provided mediocre returns, 3-4% annually like Treasury bonds, but 86 stocks drove most market gains, emphasizing the need to find exceptional companies among over 29,000 analyzed. The second rule is to systematically search from A to Z. Buffett's method involves actively seeking exceptional businesses or attractive valuations due to temporary issues. He advises investors to read extensively. When asked how he finds opportunities, he referenced Moody's book, which summarized financial data like sales, debt, stock performance, and valuations. Today, technology offers databases or screeners such as TikaAir.com listing stocks like Nvidia, Microsoft, Apple, and Amazon. Buffett uses 4 criteria: growing sales and profits, high return on capital, low valuations, and strong management. This can be applied in screeners: a stock trading below 15 times earnings market average, return on invested capital above 20, market average 13%, and earnings per share growing over 10% annually for 10 years, market average 8%. Leveraging technology and artificial intelligence requires knowledge to maximize these tools. An example screener yielded 50 US stocks, including Expedia Group and oligopoly with Booking.com in online travel, trading at 11 times earnings, market average 22. Wendy's, a McDonald's competitor, benefits from affordable fast food, performing well in recessions, and is undervalued due to less attention. SAIC, a US military contractor, dropped due to fears of defense spending cuts, but continues growing, trading at 11 times earnings, below its historical 50-60% higher valuation. The third rule is to leverage human irrationality. The market swings from panic selling to euphoric buying, often without significant economic changes. A recent 20% market drop recovered quickly, showing unchanged fundamentals. Investors should buy during fear-driven dips when prices are low. Buffett learned this during his honeymoon in Las Vegas, observing bettors risking more when losing against the odds. In stocks, people sell at lows due to impatience or buy at highs driven by emotion, taking risk at the worst times. High valuations suggest limited upside as growth slows. Buffett realized this early, believing the stock market could make him a billionaire by controlling emotions. He capitalized on this with Bank of America during the financial crisis, buying over 5 billion shares at $6-7 when banks were shunned. The stock now trades near $50, earning him over 25 billion. He earned over 80 billion investing in Apple in 2016, when it trades at 10 times earnings due to fears of losing a smartphone market share. Apple adjusts its strategy, resolving the issue. Similar moves with Coca-Cola, Geico, a major US auto insurer, multiplied over 100 times, and the Washington Post sold as media shifted to digital platforms, like Facebook and Google, follow this pattern. The COVID-19 crisis and recent geopolitical tensions created similar opportunities for patient investors. The fourth rule highlights small cap opportunities for small investors, as Buffett did early on. Buffett notes that managing $1 million or $10 million allows full investment in opportunities, unlike larger portfolios. He achieved his highest returns in the 1950s, outperforming the Dow Jones with limited capital. Small investors with less than 1 million have a structural advantage, accessing a broader universe. The Wilshire Small Cap Index averaged 40% annual returns, and selective stocks picking can exceed this. Small caps underperform during the technological advancements, like AI, making them undervalued at 12-13 times earnings versus 22-25 historically. With 10,000 US stocks, 9,500 are outside the S&P 500, offering more opportunities and less analyst coverage, increasing mispricing chances. Small caps grow faster, boosting returns, but are volatile due to less sophisticated investors, creating inefficiencies. The fifth rule is concentrated portfolio management. Buffett says 90% of his wealth comes from 20 investments. Over-diversification protects against ignorance but limits returns for knowledgeable investors. He recommends from 8 to 20 stocks up to 30 for beginners. Studies show risk decreases significantly with 20 stocks, but beyond 50, additional stocks add no benefit, increasing workload without reducing volatility. The sixth rule, the most valuable, is that the market will always offer opportunities due to human behavior repeating past mistakes. Buffett suggests two courses before investing, one on controlling psychology and another on valuing stocks to know when they are cheap or expensive. The best investment is in yourself, as knowledge cannot be taken away or taxed. The stock market is accessible today with smartphones, database, and software, leveling the playing field for small investors. However, shortcuts don't work. invest time in learning to apply knowledge over decades. Everyone, entrepreneurs, workers, students, must learn investing. Join Stocks for Beginners channel's weekly live sessions for free, quality content on finding, analyzing, and valuing stocks in a controlled environment. Your support motivates us to share knowledge, saving you time to reach financial goals. Goodbye and happy investing.